Thanks for joining us today for the Signature FD weekly investment update that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. So we'll go ahead and kick things off with market returns. Last week was another challenging week for stock market investors. The benchmark S&P 500 index was down about 1.5%, and it's now down 4.8% on the year through last Friday. Now, small cap stocks have been laggards. They're down 9% on the year. But diversification, especially international and within asset classes, that's been key. International markets are up on the year, and bonds have also gained, playing a useful hedging role in portfolios. As a reminder, diversification is our key theme for 2025. Now, we've spoken at length about the trade policy and economic policy uncertainty that's crept in mainly around tariffs. We're really starting to see that show up in consumer confidence data. Here's a chart showing the annual change in consumer confidence from the University of Michigan poll, and we're showing that here in light green. In darker green, this is plotting real consumer spending. Historically, drops in confidence can be expected to pull down consumer spending as well, and that's a risk to the economy here this year. Really complicating matters is that consumers expect conditions to worsen, but they also expect inflation to pick up. This chart shows 5-year inflation expectations in the dashed orange line, and it's overlaid on actual inflation in blue. This is the highest expected 5-year inflation since the early 1990s. That makes life hard on the Fed from a monetary policy perspective. Now, what can happen here is that consumers could become more dour and uncertain, and then they might begin to lift their savings rate. So far, the savings rate has been pretty stable at a low level. Here, we're showing the unemployment rate in blue and the personal savings rate in red. The savings rate has about a 6-month lead time on unemployment. In other words, when the savings rate starts to rise, that's a sign that spending is dropping, which eventually makes its way into the labor market. Now, recession risk is likely climbing, but for now, the employment and activity data is solid, and solid enough that recession is not yet our base case. In the absence of job losses, it isn't that difficult for consumers to turn up their spending again if some of that economic uncertainty were to be alleviated. What we're showing here is payroll growth in blue and real consumer spending in orange. There's a pretty tight relationship. This week's labor market data, that's going to be important to monitor. As for where we stand in this correction, here we're showing data on past corrections to give us kind of a historical guideline. What this is showing is that 46% of all 10% corrections do go on to reach the 15% correction threshold. Once a correction does hit 15%, then it's had a 57% chance of becoming a full 20% bear market drop. Now, that means that about 1 in 4 10% corrections do go on to become bear markets. And that risk does exist if the economy really were to hit the brakes here. If confidence does begin to return, however, then we might expect a strong rally when the dust settles. And that's what the data on this slide suggests. What this is showing is prior large drops in consumer confidence and then the subsequent market performance. Over the next year, following big hits to confidence, the market's gained a median 19%, and it's been up in 7 of 8 cases. We would therefore expect near term volatility to continue, but better conditions ahead should the fog of uncertainty begin to lift. So, some closing thoughts for this week. The ongoing correction is being driven by deteriorating consumer sentiment. Thus far, we haven't really seen the savings rate pick up, but that would be something to watch. Rising inflation expectations are complicating matters for monetary policy. It'll likely be key that uncertainty begins to be lifted and consumers pick up their spending again. If not, recessionary and bear market risks will likely rise. Join us next week to hear our thoughts on the employment data. And as always, thanks for joining us and have a great week ahead.